Imagine if you had the chance to invest in Amazon or Tesla before they went public. How much would that investment be worth today? Probably a lot. For decades, VC or venture capital was only for billionaires and Wall Street insiders. But today, doctors, dentists, and everyday investors, they have more access than ever to this high growth asset class. And in this video, I'm going to break down exactly how you can start investing in venture capital, even if you're not a Silicon Valley investor. If you're new here, I'm Dr. Jeff Anzalone. A dentist is on a mission to get you to the point where work is optional. Make sure you download the free passive income training with the link below this video. So first off, let's answer the question, what exactly is venture capital investing? Venture capital investing allows you and everyday individual to invest in private companies before they go public, offering a chance to back these high growth startups in exchange for equity. Unlike the traditional stock market investments out there, VC investing occurs in the private markets, meaning the general public can't buy and sell these investments on some type of exchange like the New York Stock Exchange. Many of today's biggest companies like Amazon, Tesla, and Stripe were once funded by venture capitalists, and their early investors in these companies, they saw returns of 10, 50, and even 100x. All right. So let's talk about what are some of the benefits of investing in venture capital. Well, number one, as you can imagine, you have a very high return potential. One of the biggest reasons to consider VC investing is that potential for that higher return, much higher than you can get in the stock market and even real estate investing. Startups that experience exponential growth can provide investors with huge profits when they go public or when they get acquired. Number two, it allows you to diversify your entire portfolio beyond stocks, beyond bonds and real estate. By adding venture capital to your portfolio, you can reduce exposure to the ups and downs of the stock market. You can gain access to private market opportunities, and you can balance risk with a high reward potential. And then number three, you get exclusive access to high growth startups. All right. Again, like I mentioned before, you have the ability to buy into these companies before they go public. Many of today's successful businesses, they grew rapidly while still in their private phase, meaning early investors benefited the most. And number four, tax benefits. Most of these investments, they qualify for structures like a QSBS, Qualified Small Business Stock Exemption. If you invest in these, it allows you to avoid capital gains tax on certain startup investments. And then some of that you've probably heard of opportunity zone investments, which offer tax deferrals for long-term holdings. So this makes VC investing an attractive option for the high-income professional looking for strategic wealth-building opportunities. Now let's talk about how you can actually invest in VC just as an individual. All right, so there's three primary ways to get involved. The first one is if you invest directly, call it a direct investment in the startups, which you've probably heard this before. It's called angel investing. Angel investing involves directly funding these early stage companies in exchange for equity. So this method offers a very high upside potential, but as you can imagine, it comes with risks. So the pros of this would be potential for extremely high returns, direct involvement with the founders of these startup companies, and there's typically no fund management fees. On the downside, the cons could be a high risk of startup failure, requires very thorough due diligence, and your investment is typically not liquid for anywhere from 5 to 10 years. All right. The second way is, and the way that I like doing this, is you can invest in a venture capital fund. Now, these funds, they actually offer a more hands-off approach by pooling money from multiple investors, and it's now managed by professional venture capitalists who have the experience investing in high growth startups. The pros are you have access to multiple, not just one, but multiple startup investments, thus diversification. These are managed by experienced investors, and they have a lower risk than individual angel investing. On the flip side, the cons would be typically you have a little bit higher minimum investment, anywhere from $50,000 on the low end, sometimes to $250,000 or more on the high end. Again, long lockup periods, anywhere between 5 to 10 years. And then at this point, there's typically fees associated with having to manage all these funds. And the third way is investing in the secondary markets. This is where investors can actually buy shares of late startups before they go public. So this allows you access to late startup, even though they have the high growth potentials. Potentially now, because you're coming later to the game, it's a shorter holding period than the early stage VC investments. And it's a lower risk now because they've been proving a proof of concept. So it's a lower risk than what's called a seed stage or early stage investing. Now, the risk would be you have less information available about the company financials, and then prices actually may be a little bit inflated due to now an increased demand. So each of these three investments, each of these three methods, they come with their own level of risk, return potential, and accessibility, giving investors multiple ways to enter the VC market. Now let's talk about who can actually invest in venture capital. These types of individuals typically must qualify, just like when we're investing in real estate syndications, mostly for accredited investors. Well, what is an accredited investor? This is somebody that has a net worth of at least $1 million, excluding their primary residence, or they have an annual income of $200,000 or more single, or $300,000 or more for couples for the past 2 years. Now, there are some available opportunities for non-accredited investors through certain crowdfunding platforms that are out there. Now, and then also some of the regulated funds, they allow lower minimum investments. The typical minimum investment ranges for, let's say for angel investing, anywhere from $5,000 to $50,000 per startup. Typically in your VC fund, it's going to be anywhere from $50,000 to $250,000 minimum. And then it can vary very much in the secondary markets, typically starting off at $10,000. So now let's talk about some of the risks that's involved in venture capital investing. Now, despite venture capital, the benefits, it also carries certain risks. Just like really any investment out there, there's going to be benefits and there's going to be risk. The first one, probably the most important one, is a high risk of failure. High risk of basically you losing your money. You have to know this going into it, because why? Most startups fail. Only a small percentage of companies achieve huge success, making diversification key, in my opinion, to VC investing. Again, this is why I like to stick with VC funds instead of the angel investing, where you're just investing in typically just one company. Number two, like we mentioned before, your investment is going to be illiquid. Unlike stocks, these VC investments, they cannot be sold easily. So typically investors have to wait, remember, anywhere from 5 to 10 years for an IPO or an acquisition in order for you to exit your investment. And then number three, the top VC funds and startup deals are often invitation only. So that means that the access to getting in to these funds or to these investments is difficult. It's all about who you know. So without the proper connections, it can be very challenging for the everyday investor to access these different types of opportunities. So why is now the best time to invest in venture capital? Well, in my opinion, and the literature out there, the data out there, probably the top reason, and you could probably think about this, where I'm going with this, one of the top reasons, if not the top reason, to invest in venture capital now is because of this, AI. Specifically, the AI startups. The number of AI startups out there are just completely booming. There's a record amount of VC funding right now, you can go look it up online, flowing into artificial intelligence, flowing into machine learning and automation. So these VC firms, they currently hold billions, with a B, billions of dollars in dry powder or unallocated capital, and they're positioning the industry for significant deal activity in the coming years, mainly again with AI. So additionally, startup valuations have actually adjusted after recent market shifts, making it a very attractive entry point for investors. So the question remains, should you invest in venture capital? Well, if you want access to high growth startups with sky high potential returns, then VC investing may just be right for you. However, remember, it requires a long-term mindset and an understanding of the risk involved. Now, if you want information on the VC fund that I personally invest in, drop me a comment below and I'll send you the information. Take care.